Imagine this, two of the most powerful forces in global finance, managing tens of billions, backed by decades of experience, armed with the most sophisticated technology and the sharpest minds, delivering double-digit returns. Sounds unstoppable, right? But here's the twist. Despite their dominance, in 2025, they trailed smaller, faster, hungrier rivals. That's right. The giants performed well, but agility and precision outpaced sheer scale. Tonight, we peel back the curtain on a year that challenged everything the industry thought it knew. We're talking market turbulence, lightning-fast sector rotations, and opportunities that disappeared almost as soon as they appeared. This isn't theory. This is a battle of strategy, speed, and execution played out in real dollars, real trades, and real risk. So buckle up, because what you're about to see is not just numbers on a screen. It's a story of power, precision, and performance where size matters, but agility wins. And by the end, you'll see why even the titans of finance can be humbled in a single decisive market move. This is the world of hedge funds at their fiercest, and you're about to step in. ID in the modern hedge fund landscape, especially looking at the 2025 performance data, the first keynote, market context matters, isn't just a line in a speech. It's the backbone of how major investment organizations operated through one of the more dynamic and unpredictable market cycles in recent memory. When we talk about Millennium and Citadel delivering double-digit returns while trailing smaller rivals, we have to recognize the environment in which all of this unfolded, a year defined by volatility, shifting macroeconomic forces, rapid equity market gains, and tactical repositioning. The narrative of 2025 was not static. Markets gyrated between early year turbulence, in part driven by geopolitical developments and trade tensions, and a powerful rebound as broader equities gained traction. Major stock indexes rallied strongly in the second half of the year, creating an environment where long positions and equity exposure became materially rewarded. Larger hedge funds, with their diversified multi-strategy portfolios, were positioned to capitalize on this, helping them deliver positive results overall. Understanding this backdrop helps explain why Millennium and Agile, two of the most institutionalized, deeply resourced, and analytically sophisticated hedge funds in the world, posted respectable returns of roughly 10.5% and 10.2% respectively. In isolation, those figures signify competency, resilience, and disciplined execution in a market that witnessed sharp structural shifts. They underscore an ability to absorb turbulence, reallocate risk dynamically, and ultimately protect and grow capital for their investors. However, merely presenting returns without context misses the deeper truth: performance is relative. While double-digit gains in any year are notable, particularly amid macro-level headwinds, they also sit against a backdrop where smaller, more agile funds outpace these titan organizations. Funds such as Exodus Point returned significantly higher gains, around 18%, while other mid-sized competitors delivered returns north of 12%. Why did that happen? Smaller hedge funds often benefit from structural advantages that aren't immediately obvious to the casual observer. With leaner capital bases and fewer layers of bureaucracy, they can pivot rapidly, adjusting exposures, rotating sectors, or reallocating between asset classes with remarkable speed. In a market environment where dispersion was high and opportunities were concentrated in discrete pockets, this agility translated to outperformance. By comparison, larger funds carry inherent constraints, liquidity management considerations, capacity limits in certain trades, and the need to balance multiple mandates across vast asset pools. These factors inevitably temper the velocity of their tactical responses, even when they possess vast analytical firepower. This leads us back to the essence of the first keynote. Context matters more than results alone. You cannot evaluate performance without understanding the market conditions that produced it. You cannot interpret a return number without recognizing the interplay between size, strategy, and opportunity sets. And you certainly cannot appreciate why traditional giants might trail smaller rivals without acknowledging the fundamental shifts and how capital can be deployed in real-time market environments. In summary, the 2025 market was fertile ground for returns, but it was uneven terrain. Large, highly diversified firms produced solid results. Smaller, agile peers captured more of the upside. Against this backdrop, interpreting performance requires not just headline figures, but a nuanced understanding of market structure, strategy execution, and the relative advantages and limitations of funds of varying size. In examining the second keynote that Millennium and Citadel delivered double-digit returns, we are looking at a performance story that reflects both skill and structural advantage. In 2025, these organizations navigated a market landscape that was anything but ordinary. We saw macroeconomic volatility, fluctuating interest rates, inflationary pressures, and rapid sector rotations across equities and fixed income. Despite all these moving parts, both firms achieved returns in the range of 10.2% to 10.5%, numbers that on the surface convey stability, discipline, and reliability. But the real story lies beneath the headline figures, in how such returns were engineered through strategy, execution, and a deep understanding of risk. Double-digit returns in a year that was simultaneously challenging and opportunistic are a testament to the strength of multi-strategy approaches. These organizations operate across equities, credit, quantitative strategies, and systematic TRA. DING, a combination designed not only to capture upside, but to insulate against downside shocks. For example, when equity markets surged mid-year, allocations to long positions in high-growth sectors were carefully calibrated to capture momentum without overextending risk. Meanwhile, fixed income and credit exposures provided a buffer against volatility in other asset classes, ensuring that the portfolio could withstand sudden shocks without catastrophic drawdowns. The sophistication of their risk management systems cannot be overstated. Real-time analytics, proprietary algorithms, and a constant reassessment of correlation risks allowed these funds to respond dynamically to market shifts. Decisions were not reactive but anticipatory, shaped by extensive scenario modeling and a commitment to disciplined execution. Every trade, every allocation adjustment, and every hedge was evaluated not in isolation but in the context of the entire portfolio's risk-return profile. This multidimensional approach is what enabled them to secure double-digit returns even when markets were unpredictable. It's also important to understand the human element. Teams of analysts, traders, and portfolio managers work in a highly coordinated fashion, leveraging deep expertise across sectors and geographies. This collective insight ensures that opportunities are identified early, risks are mitigated efficiently, and strategic pivots are implemented without hesitation. The integration of technology and human judgment amplifies the precision of execution, allowing them to take advantage of fleeting market inefficiencies that smaller, less resourced players might miss. Yet these returns also highlight a structural reality. Scale is a double-edged sword. Managing tens of billions requires balancing liquidity constraints and ensuring that trades do not materially impact market prices. While these funds are capable of capturing significant opportunities, they cannot move as nimbly as smaller vals in concentrated trades. Still, achieving double-digit returns under these constraints demonstrates exceptional skill in portfolio construction and capital allocation. It is not merely a reflection of market conditions, but a result of thoughtful, data-driven decision-making executed with discipline and rigor. Ultimately, the takeaway from this keynote is that double-digit returns in a turbulent market are not accidental. They are the outcome of comprehensive risk frameworks, diversified strategy deployment, technological edge, and relentless attention to detail. It's a lesson in how performance is built, not simply on bold bets, but on the orchestration of multiple levers in harmony, creating results that are both robust and sustainable. In analyzing the third keynote, the outperform rants of smaller, more agile rivals, we confront a phenomenon that has become increasingly relevant in the hedge fund industry. In 2025, while the largest funds delivered solid double-digit returns, mid-sized and smaller firms captured outsized gains, with some posting returns as high as 18%. This disparity underscores a fundamental principle in investing. Size and scale provide stability, but nimbleness often delivers alpha in dynamic markets. The environment of 2025 was uniquely conducive to such outcomes. Equity markets experienced rapid sector rotations, volatility spikes, and uneven liquidity conditions. In such a landscape, smaller firms enjoyed structural advantages that allowed them to move decisively and exploit opportunities that larger institutions could not. These firms operate with leaner portfolios and fewer capital constraints, which means they can concentrate positions, enter and exit trades swiftly, and leverage market inefficiencies in ways that larger funds managing multi-billion-dollar books often cannot without moving prices against themselves. Agility becomes more than a convenience. It becomes a competitive advantage. Smaller teams can make strategic decisions without the layers of oversight and committee approvals that are necessary in massive organizations. Their capital deployment is precise, often targeting high-conviction ideas rather than the diversified but diluted allocations required by larger funds. This focus enables them to capture significant upside when market conditions favor their chosen strategies. In 2025, these characteristics translated into measurable results: concentrated positions in emerging sectors, tactical exposures to volatility products, and timely rotations between asset classes all contributed to exceptional returns. Technology and data analytics also play a central role. Smaller funds are increasingly leveraging sophisticated algorithmic tools, artificial intelligence, and real-time market analytics to make informed decisions faster than their larger counterparts. The capacity to integrate quantitative insights into rapid trading decisions allows these firms to exploit micro opportunities that might be too small or fleeting for a giant fund to pursue without risking systemic impact on the market. This speed and precision gives smaller firms an edge that is difficult to quantify but impossible to ignore. Yet it is not only about speed. Smaller firms often adopt unconventional strategies that are too concentrated or niche for massive portfolios. Whether it is tactical credit trades, sector-specific arbitrage, or targeted options plays, the ability to pursue strategies with high payoff-to-risk ratios gives them a structural advantage in generating superior performance. In a sense, the small fund can think and act like a scalpel, while larger funds operate more like a sledgehammer, effective but less precise in seizing fleeting opportunities. The contrast between smaller and larger funds in 2025 illustrates an essential truth about performance. Outperformance is context dependent. It is not a critique of the capabilities of the largest institutions, which maintain disciplined RIS, K-frameworks, and multi-strategy portfolios, but a recognition that size introduces constraints. Capital deployment becomes complex, market impact is magnified, and the agility to pursue concentrated opportunities is inherently limited. Smaller funds, unburdened by these constraints, exploit niches and structural inefficiencies to capture returns that may exceed those of their larger peers. Ultima Telly, the lesson from this keynote is that in a market defined by rapid change and high dispersion, nimbleness and focus can trump scale, at least in relative performance metrics. The rise of these smaller competitors serves as a reminder that markets reward not only resources and expertise, but also adaptability, decisiveness, and the willingness to act boldly when opportunity presents itself. In examining the fourth keynote, the industry's shift toward nimbleness, we are looking at a trend that has been quietly reshaping the hedge fund landscape. 2025 underscored a truth that has been emerging for years. In a world of rapid market evolution, the ability to pivot quickly, to redeploy capital strategically, and to act decisively is often more valuable than sheer size or scale. The giant of the industry remain formidable, managing tens of billions across diverse asset classes. Yet the market has increasingly rewarded firms that can navigate turbulence with agility, precision, and speed. The environment in 2025 was a perfect illustration of this principle. Volatility spiked, Sectors rotated with uncommon rapidity, and liquidity shifted between asset classes almost instantaneously. Traditional multi-strategy portfolios, while diversified and robust, faced inherent friction in redeploying capital at the pace required to exploit these opportunities fully. In contrast, smaller and mid-size funds, operating with leaner structures and less bureaucratic complexity, could enter and exit trades with precision, often capturing upside that larger portfolios could only chase with partial participation. The result, smaller players frequently outperformed larger counterparts despite having fewer resources. This shift toward nimbleness is not just operational, it is strategic and cultu. RAL. Successful funds of 2025 embraced a mindset where speed of execution, iterative analysis, and tactical focus became core principles. Capital allocation decisions were no longer solely driven by long-term macro assumptions. Instead, they were guided by real-time market intelligence, rigorous scenario testing, and a willingness to pivot when the data dictated a new course. This approach demanded not only technological sophistication, but also highly aligned teams capable of acting without hesitation. It is this combination of data, insight, and decisiveness that allowed agile funds to capitalize on narrow windows of opportunity, while larger funds methodically processed information and risk assessments. Technology was central to enabling this nimbleness. Quantitative models, AI-driven and analytics, and algorithmic trading systems allowed funds to identify patterns, forecast short-term market movements, and execute trades with speed and precision. Where a massive portfolio might be limited by liquidity constraints or operational lag, these tools allowed smaller funds to operate with surgical accuracy. In addition, digital risk monitoring and portfolio optimization systems meant that funds could take concentrated bets without exposing themselves to unmanageable downside. The integration of technology and strategy became a force multiplier, enabling rapid responsiveness that was increasingly rewarded in the market. The broader implication for the industry is clear. Scale provides stability, reputation, and resource advantages, but nimbleness provides opportunity capture. Investors increasingly recognize that in a fast-moving environment, the ability to adjust positions quickly and exploit short-term dislocations can materially impact returns. For this reason, even the largest funds are studying and adapting elements of agility, embedding more flexible capital deployment frameworks, enhancing real-time analytics, and fostering decision-making structures that reduce latency. Ultimately, the fourth keynote demonstrates that markets reward adaptability. While size remains a formidable advantage, the evolution of investment strategies is pointing toward an era where speed, precision, and decisiveness define success. Those who embrace this shift, integrating analytical rigor, operational flexibility, and a culture that empowers swift action, are positioned to captain your opportunities that traditional, slower-moving frameworks may miss. The lesson is unambiguous. In today's markets, nimbleness is no longer optional. It is essential for sustained outperformance and long-term relevance. In examining the fifth keynote, that outperformance is relative, we confront a fundamental truth of investing that is often overlooked in the headlines. In 2025, while the RGS funds delivered solid double-digit returns, smaller and mid-sized competitors frequently outpaced them. This does not diminish the achievement of the giants. Achieving 10% or more in a volatile market is a testament to disciplined strategy, robust risk management, and operational excellence. Yet, in the context of peers, relative performance becomes the lens through which real success is measured. It is this concept of relativity that defines how investors, analysts, and markets judge outcomes. Understanding relative performance requires recognizing the constraints and structural realities of size. Large funds manage capital at scales that impose inherent limitations. Liquidity considerations, risk concentration limits, and the necessity of maintaining diversified portfolios restrict the degree to which they can exploit narrow, high-conviction opportunities. In contrast, smaller rivals are often unconstrained by these factors. They can concentrate their capital where conviction is highest, rotate positions quickly, and pursue strategies that may be impractical for multi-billion-dollar portfolios. In markets characterized by rapid change and high dispersion, like those experienced in 2025, these structural advantages translate into performance differentials. Moreover, relative outperformance is contextual, shaped not only by absolute gains, but also by market conditions. The larger funds achieve returns of 10 to 11%, which in isolation are excellent results. However, in a year where smaller, nimble firms delivered 15 to 18%, the perception of success is inevitably tempered. The market rewards those who can both protect capital and exploit opportunity most efficiently. This principle highlights the importance of assessing returns through the lens of opportunity cost and alternative outcomes. Investors are not only concerned with whether a fund made money, but whether it maximized potential gains relative to its peers. This relativity also emphasizes the evolving metrics by which performance is evaluated. Traditional measures such as absolute returns are insufficient in a complex environment where strategy execution, speed of decision-making, and tactical flexibility are increasingly valuable. Risk-adjusted performance becomes a critical component, as does the ability to generate alpha in concentrated pockets of opportunity. Large funds may deliver stable returns, but smaller competitors demonstrate how concentrated bets and agile allocation can produce outsized results relative to market conditions. Furthermore, this keynote underscores a strategic lesson. Absolute success is not static. The giants of the industry are still highly successful by any measure, but their relative underperformance in specific cycles is a reminder that the investment landscape is dynamic. It rewards those who adapt, pivot, and deploy capital with precision. Performance is therefore a moving target, contingent on both external conditions and internal capability to exploit opportunities in real time. Ultimately, the fifth keynote teaches that performance must always be evaluated relative to context. Strong returns, disciplined risk management, and operational excellence are necessary but not sufficient. Outperformance is defined not only by what is achieved, but by what could have been achieved in the same environment. This perspective encourages a nuanced understanding of success where scale and stability are weighed against agility and execute. And where investors appreciate that true excellence is measured by both absolute and relative results in a dynamic, ever-shifting market. So here's the reality. In a world of lightning-fast markets and constant disruption, size alone is no longer the ultimate advantage. The giants delivered double-digit returns, impressive, yes, but the nimble, the agile, the bold seized the moment and rewrote the rules of success. And that's the lesson for every investor, every strategist, and every thinker watching today. Opportunity favors those who move decisively, who act with precision, and who refuse to be bound by tradition or scale. The landscape is shifting, the players are evolving, and the markets will reward the fearless. So as we close this chapter, remember, it's not just about how much you can manage, it's about how quickly you can adapt, how sharply you can execute, and how boldly you can seize the advantage when it pairs. Stay alert, stay decisive, and never underestimate the power of agility in a world built for giants. The next opportunity is already here, and only the prepared will dominate it. Are you ready to be one of them?